So a lot of people who are coming into a market and they're looking to buy a business, right, a small private business, let's say between 1 to 5 million EBITDA, they usually go the broker route, right? There's already businesses that are listed for sale. The owners are looking to sell. But one thing that is very important is what evaluation method you use to make an offer on it, where you can figure out what's the true cash flow. Because as what I know, EBITDA, seller discretionary earnings, and NOI has many addbacks. So essentially, you're overpaying, and also net earnings does not report maybe what's true due to any depreciation or amortization or playing around with taxes and numbers. What do you think is the best way initially without getting involved in too in-depth due diligence to make your offer on it?
Well, here's the answer. I mean, it used to be a lot easier than it is now. Let me put it that way, because it used to be there was more stability. You could go to a source like Deal Stats and look up in the industry what transactions have occurred. Again, all these are anonymously reported. You can kind of derive a range of valuation multiples on EBITDA or with respect to sales or revenue or whatever valuation metric you want to look at from those deal stats. But what's happened is, with COVID, there was a huge drop off for one thing in transactions for a while there. So a lot of the reporting just hasn't caught up. I know volume is picking up now, but the reporting hasn't caught up. But the other problem is that there are companies that are at both ends of the spectrum. Some experienced huge declines and are in big trouble. For example, I was doing MRO transactions near in Florida, near Ansi there in Miami, and they were trading at 10 multiples of EBITDA for $1 to $2 million EBITDA businesses. That's how intense it was. And now I'm working on a deal where it's practically liquidation value because it's just turned topsy-turvy because of COVID. But conversely, I just represented a seller, and I also do sell-side diligence, by the way. I just represented a seller of a PPE company, and they made a killing. There was obviously a windfall for them. So really, all the metrics that people have been used to seeing are kind of out the window and unstable and uncertain at the moment. And all that's leading to a greater use of earnouts. Actually, the Wall Street Journal said that the incidence of earnouts has doubled from about 25% excluding life science now up to 50%. And I'm doing a session on that in February for the AMA. I'm moderating a panel on earnouts, just talking about why this is arising, what it means, how to deal with it. But that's really where in terms of valuation, people are filling the gap. It's with earnouts. So that would be the conventional way of doing like an initial assessment. Now, I work with a lot of private equity groups too, and they basically have proprietary models, and it's all some variant of discounted cash flow. I mean, and that's really, if you want to get into a more precise way of doing it, you're building your own multiple. Basically, you're going back to all the risk factors involved. You're trying to assess each one individually, building your own multiple, looking ahead to the future. So it's a much more laborious exercise, but that's what people in this environment kind of have to default to. They're making more investments in the valuation aspect because there's more uncertainty right now. So that's kind of my take on it. But EBITDA has always been the middle market metric. I mean, and I'm actually doing a white paper on this now. I know that people like Warren Buffett hate it, but he's at a different market than we are. I mean, EBITDA is the number. I remember there's one broker who used to walk around saying that he has only one function key on his calculator, and that function key was 5x. That was that's all his calculator did was 5x. So I mean, that's how ingrained it is. And as far as Addbacks, that's why you do due diligence. I mean, it was funny. I did a transaction a number of years ago where there was a $5 million EBITDA, but that was only after $7 million in Addbacks. So, at some point it becomes ridiculous. I mean, for example, I work in an accounting firm, of course, and we're very seasonal, and there's going to be downtime during the summertime. Is all that an Addback, to an accounting firm's EBITDA? I don't think so. But there might be aggressive people that would argue that, and some aggressive people that,
So,
oh yeah, that's an ad back. You don't that was inefficiency. That's an ad back. So in other
okay,
words,
Bill.
you have to scrutinize. You really, I mean, the ad backs you just have to scrutinize, and that's why you bring in a guy like me because I've seen it all. Believe me, I've seen it all. But go ahead, Ansi.
No, I was going to say. So what so is it that in the lower middle markets we use EBITDA, and the higher markets higher enterprise value deals, is it that they use net cash? Is that what you're essentially saying?
Oh, you mean, oh, I'm sorry. You're saying middle market versus, you're a little muffled there, Ansi, but say it one more time. I'm sorry.
So can you hear me?
Yeah, I can hear you now. Go ahead.
No, what I'm saying is, so I was trying to paraphrase what you said just to get a better understanding. Is it that in the lower market, well, yeah, lower middle market, if you will, where we are, one,
Right,
two, three, four, $5 million deals, is it that we
right.
use EBITDA in the larger enterprise deals, 20, 50, 100 million, 200 million, or whatever? Is it that they use net? Is that what you're saying?
Yeah, oh, yeah,
Is
no,
that
it's
a
a
better
whole
time to
different,
use that, or?
it's a whole different world. Yeah, if you're dealing with public companies like Warren Buffett, you're dealing with a whole different thing. You're looking at return on capital employed, or I mean, you're doing
Right,
you're
right. That's what I'm
you're doing a
saying.
whole
So,
different metric system. Yeah, because that's a different
okay.
world. Our world is EBITDA. Our world is just is EBITDA driven. Is it?
Yeah,
I'm
because
I'm
I've heard
working
that a
on
lot.
right.
I've heard a
Yeah.
lot of people say that, if it's EBITDA, you're overpaying. But I never really understood, what the concept is behind it. Of course, I understand it. Yes,
Right.
a lot of things, that's into that you're overpaying for. But the way you just kind of broke it down, I never saw it that way, right? I thought it
No,
was
well, and the
more,
concept is this. I mean, the concept is this that, yeah, there's different levels of capital intensity. Yeah, there's different levels of bankable assets. All of that affects multiples, but then you're looking industry specific. Everyone knows that, a distributor has a lower multiple than a manufacturer, and contractors have lower multiples. I mean, everyone kind of has that ingrained because we can see the data. So in other words, we don't have to do that level of analysis. That's so EBITDA is a good metric because we understand that it varies by industry, and we can apply the right number in the right circumstance. So that's kind of what it is on that one.
is it possible for us to this is a long shot, but is it possible for us to like do maybe a example of a deal, maybe one that I sent you? Obviously, they won't be able to see the numbers. You will, but
Oh yeah, yeah, no,
I
and
know the numbers off
unfortunately,
the top of my head.
unfortunately, I haven't even had a chance to look at that yet. But I could go through another one. I just did I did a deal where it's interesting. It's gosh, I can't give it away though. I'm just trying to think of how to describe it. There are implants that are used in certain bones, that I mean to repair certain bones, and these are proprietary developed products, and this company's looking to go public. And I can go through a diligence with you. I mean, the first thing that struck me about the company was that it had 4 years worth of inventory, and I'm wondering what's going on here. There's something wrong here. And not only
Yeah,
that,
no,
it had,
no. Real quick. Yeah, but
sure.
the reason I said Mike is because a lot of us on this call is in the same market as I am, the lower middle market.
Oh,
So
sure.
I'm not sure if what would it differ for a company that's about to go public, versus
Oh,
a
no,
small
no,
to
they
medium
were
sized deal.
still early stage. Yeah, they were. I mean, it's a little larger than some of your deals. I mean, it's like they're doing like 30 million revenue, so it's not massive. But just to go through it, quickly, an implant company, so I look at it, wow, 4 years worth of inventory, and then I look at fixed assets. Wow, there's stuff that's out in, that they actually had like parts, these kits that were carried as fixed assets, and I'm wow, that's kind of unusual. So peeling back the onion, it turned out that they had items out on consignment that had never been verified, never physically verified, and they said, "Oh, well, we can always get them back," but there was no credit assurance with their representatives that were selling these items. Was one thing. For another, it was interesting, but the fixed assets actually were sold about 30% of the time to distributors. They weren't always used in these consignment arrangements, and they put them through fixed assets, and they used this is a fun one. They used a special method for fixed assets where they relieve the oldest ones first. It's called a pooling method, and you're allowed to do that. But so they wound up with every sale relieving zero book value fixed assets. So in other words, they had pure revenue, pure profit, pure EBITDA from every one of these sales just from this accounting method. And this was a company that was audited by a very large accounting firm whose name you'd recognize. and those types of issues just kind of really had a huge impact on what they were presenting. So that's the type of thing that you can encounter now in typical deals. Things like I mean, issues are going to come up with unrecorded accruals. They're going to come up with receivables that are bad. I just did a deal last week where there was a large old receivable. It turned out that it was covered by a retainer that had been taken into revenue. So I mean, it was a pure hit to EBITDA. There have been situations where people capitalize things inappropriately. Okay, we put in new software, so we capitalize 4 months of the CFO's salary. Okay, I mean things like that. I mean, so it's kind of like you know what to look for. Oh, another thing I in a very recent deal, actually on Long Island, a contractor, they included $1.1 million in revenue as they received their PPP loan. They put it straight to revenue, and my buyer didn't know that.